Prepare for a meltdown in the housing market in the coming year. A pandemic-induced property bubble reached its pinnacle by the end of 2021, and the industry is now preparing for the biggest decline since the financial meltdown. Strangely, the news press is avoiding the topic and ignoring the reality that expensive costs have driven many potential customers away from the market. Many well-known figures in the financial sector have been warning that the housing bubble would burst in the new year as a result of the almost 50% increase in property prices since 2020 and the more than doubled mortgage interest rates. These experts are confident that aggressive rate increases by the Federal Reserve would result in a sharp decrease in consumer spending, triggering a broad economic slump and a surge of layoffs. Home values may drop by at least 50% according to analysts, and there will be worse suffering than during the subprime housing meltdown of 2008. The reasons for this disaster are many, but for the time being, we'll focus on 3 leading factors. Let's examine these factors one by one. Before continuing, we respectfully request that you support our efforts by subscribing to our channel so that you won't miss any of our next videos. One of the main factors that could lead to a housing market crash is the influx of investors. More homes than ever are owned by people who don't live in them. Between 20 and 30 million single-family homes in America are owned by investors, according to CoreLogic. This represents 25% of all single-family dwellings in the nation. We had more individuals living as principal residents in the home during the 2008 housing meltdown than we have now. With new apartment construction reaching a 50-year high, 2023 will be the biggest year ever for the completion of new apartments. Apartment developers saw a 20% increase in rent in 2021 and went all in. Markets are dominated by investors in places like Charlotte, Atlanta, Phoenix, Tampa, and Vegas, where they own 50% of the properties in some zip codes. So what does all of that mean? A record amount of rental inventory is about to flood the market. More competition between investors can cause rents to drop and profits to decline. This may make it more challenging for landlords to recoup their investment and may result in fire sales, where properties are suddenly sold for far less than they're worth. Home price pressure from this may cause the market to implode as a whole. The second contributing factor to the home market crisis is the worldwide stock market sell-off. We all know that the United States is facing a demographic challenge as the baby boomer generation approaches retirement age. The majority of their wealth is currently concentrated in their stock portfolios and home equity, and at the same time, their bond holdings have also been severely damaged. The baby boomers' purchasing power has been restricted in a number of ways. Because of inflation, prices are up 8 to 10%, and baby boomers are impacted the most. The majority of government incentives, such as mortgage concessions and direct payments, are either about to expire or have already done so, which will put further strain on baby boomers who are already approaching retirement. The S&P 500 chart seen here dates back to January 2022, when the stock market was at 4,800. It dropped over 1,000 points to 3,500, a decrease of almost 20%. If you're one of the people planning to retire and the bulk of your total wealth or retirement is in your 401k or stock portfolio, you must be in a panic right now. People must be thinking to themselves, how am I going to retire? Home equity is the only lever they have to pull. As a result, more homeowners will be compelled to sell their homes, which is terrible because most have substantial home equity but believe that home values are stagnant because they read the news. In other places, these prices are actually declining. Most of these folks are forced to sell their houses as a result of this predicament. But we must keep in mind that there's a margin built into property prices and the real estate market. What does that mean? There are 84 to 85 million single-family houses in the United States. However, there are only 500,000 of them available for purchase in any one moment. As a result, the prices for all 85 million houses are determined by the demand for these 500,000. I bet you're wondering, how is it possible for prices to decrease in this market? This leads me to the third factor that's contributing to the housing market crisis: high mortgage rates. It's been reported that 30-year fixed mortgage rates have increased to 7.2%. These are significant numbers. 2 years ago, these figures were merely 3%. According to analysts, structural inflation will lead mortgage rates to increase steadily for some time to come. Because borrowing money to purchase a home becomes more expensive due to high interest rates, this might cause a housing slump. The cost of borrowing rises when interest rates rise, which makes it more challenging for consumers to qualify for mortgages. Reduced demand for housing can result in lower home prices when fewer individuals are able to purchase homes. Further slowing the economy is the possibility when people are paying more interest on their mortgages. They may be less inclined to make other significant purchases like cars or appliances. This might lead to a vicious cycle where falling demand for property prompts higher loan rates, further decreasing demand and causing home values to decrease even more. Let's look at what happened in the UK. There was a recent economic crisis where their bond market exploded and their pension funds nearly went bankrupt. The same may occur in the US. This could force the Fed to decrease interest rates and offer buyers some breathing room. Analysts believe this would only be a temporary fix and make matters worse. They call it financial duct tape. So, what's the takeaway? The housing market is at risk of crashing due to a combination of factors such as too many investors, a worldwide stock market sell-off, and a demographic challenge as the baby boomer generation approaches retirement age. If you enjoyed the content of this video, please like and subscribe to the channel for more content on real estate.